Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
There's the benefit globally, in the enhancement globally in terms of growth. A lot of people say that, technology is, we're not quite sure where we're going to find the next technological revolution. We never know where that is, but they say a lot of that is really near the end of its life cycle of what the venture capitalists have looked at before. But we definitely believe that the next real boom in global growth for the economy is the final unleashing of the emerging market consumer, especially the Asian consumer, as this process takes place. It'll be just a natural growth process for the world. And ultimately, if China will make a change in its currency policy, because it will benefit them, and I'll show you that. This whole process could also lead to more balanced global trade, and that's the rub here. We're pretty optimistic once we get through this period, over the next, 4, 5, 6, who knows, years in the U.S. as we continue, if we get our act together. I mean, if you look at some of the numbers on the fiscal side, they're worse than disastrous, but that can change. I think if we can get through this period in the next several years, we could see more stabilized and lower volatility growth going forward. But I won't get into all of that. But this is a natural process of squeezing out, from a real global macro standpoint, value for the emerging market economies, and China is quickly moving down that path. This point here just shows, this is showing just the savings, the relative savings of relative to gross domestic product. And you can see China has just, year after year from 2001 on, has only been updated through 2006, and it's from Standard & Poor's, this chart, up over 50% in terms of the savings rate. Now, that's all, and that goes to that forced savings that I talked about in China, and you tend to see that too in other markets, but China really does it from a policy perspective. And another thing is, China, because they've driven so much into their export and so much in infrastructure, that is their economy, and they really haven't provided the safeguards to provide, for the consumer being a person in China that has to save a lot in order to, for a rainy day. He doesn't have the Social Security, the insurance, all those types of things. If he gets sick, he has to go, to the hospital and pay cash. So so not only do you have artificially low interest rates in China, not only do you have the capital controls that don't allow the Chinese citizens to move their money offshore, you don't have the safeguards in China for the citizens, the fallback mechanisms that are necessary to build a vibrant or stable consumer economy. So what happens, you get these massive amount of savings. And so if you look at them in another way, it's really just stored up wealth or stored up capital that potentially will be unleashed. And when we say that we think that's going to be the next driver, and again, not that we're the first to see this, people saw this many, many years ago, but we're on the cusp of this starting, potentially starting to change as China starts to see the advantages of building the domestic economy. And ultimately, the path toward a vibrant domestic economy for the Chinese citizen is a path for them of creating more freedoms for them, and especially in a time when we have such global dislocation and uncertainty, is why the Chinese the Chinese policymakers are still very, very nervous and have still been hesitant to make a move on building a domestic economy, even though they know it's going to be ultimately very beneficial for them. I mean, think of it this way: they're dependent so much on the U.S. for driving, their export growth. Why would they ever want to be that dependent on somebody else when they ultimately don't have to be? And the reason is, socially, they're just afraid to make that change at the moment. Just looking at this chart and just comparing, if you just compare some of the major things, and this goes again, especially with China, but also across the emerging world compared to the developed world, big budget surpluses versus budget deficits, trade surpluses versus trade deficits. The deck is really stacked from a wealth standpoint, or to the emerging markets, and that's why you're seeing that wealth just continuing to transfer into the emerging and developing world, because think of them, if you would look at the developed world and the emerging world as two different companies, and you look at their balance sheets, one would look very, very good and the other would look awful. And not only the one looks very, very good, not only does the balance sheet look good, but the growth opportunities look good for all those things we just talked about. The driver of GDP and growth as economies develop comes from the consumer, and they haven't even unleashed that yet. So there's no surprise why the money continues to move offshore out of the developed world in general, not just the U.S., for these opportunities. And given that the developed world has burdened themselves with so much debt during this because of the credit crunch, the growth opportunities, you're going to have lower capacity or sub-capacity growth potential really in all the developed world going forward, which is another reason you're going to see people in the developed world that have the money moving it offshore, stretching again for yield, stretching again for return. And why we think these currencies, these emerging developed world currencies, if you just look at them purely on a global macro basis and think of nothing else, you want to have access to this area in your portfolio. So no doubt you're going to see volatility, but I think long term, if we wake up in 10 years and we look at the valuation of some of these, especially the Asian bloc currencies, where they are now, where they will be in a decade, will be, I think we'll be shocked. Obviously, we could be very wrong, but we think they're extremely undervalued, and I'll get to the reasons why in just a second. Presently, China has what's called a crawling peg. Their currency regime is what's called a crawling peg system. In July of 2005, they made this one-off appreciation against the U.S. dollar, and it went up 2.1%. And that's when I said back then, all the economists were very excited, and all these bankers that had these multi-currency accounts did all this advertising, come invest in the Chinese currency, and you're going to pretty much make money all the time, because from now on they're going to continue to increase the value of the currency. Well, they haven't really done anything since then of significance. So because of the reasons that I said, they allow supposedly the currency in this peg system to fluctuate each day, and these are the general rules. But ultimately, China makes the rules and determines what happens in that basket. The rumor now in the markets by different people around the world is that China will revalue its currency anywhere from 5 to 10%. Two reasons we think that could happen. Number one, we have it's kind of a bone that they're going to throw to the West, because there's a lot of pressure growing, and I'll explain why. And number two, you're seeing they probably want to get out in front of this. I think next month the U.S. has their big global report on who's manipulating trade type of thing, and China wants to get out in front of this and probably and squash that. And also I think China is realizing that they need to really start focusing more on this idea of the consumer. And big speech by forget his name. Last week, in fact, said we need to start focusing more on the consumer. So they are understanding that they need to make this transition and realizing that the money that they spent in here in stimulus really went too much into driving infrastructure growth at the expense of creating internal demand.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.